What's going on there, everyone? Welcome to the channel. In today's video, I'm going to talk about a question that I get asked a lot, especially over on TikTok, and that is, what are the best dividend companies that I can buy? It seems that dividend companies are all the rage right now. Everybody's chasing after dividends, and at the end of this video, I will share the two best dividend companies, in my opinion, that I like right now. But first, I want to talk about something even way more important than picking what dividend company you want to buy, and that's how to avoid the dividend trap. People often say if something seems too good to be true, it often is. And that's what happens in a dividend trap, especially as interest rates are rising, the economy seems to be slowing down, stock market is starting to come down a little bit. People are intrigued and more after seeking after a stock that pays a dividend in the hopes that that dividend yield will somehow protect them in the stock. One of the things that people often do in that scenario is they seek out very high yielding dividend stocks. They want a stock that pays a high dividend. Let's go ahead and take a look at this, and ironically enough, using AT&T against CenturyLink in this example, but man, how times have shifted. I'm going to talk about what happened today in AT&T stock, as it in itself has become a bit of a dividend trap. One of the key things that you need to look at when you're trying to avoid the dividend trap is comparing your stock to its peers, other things in the same industry. What's the average yield? What's the average dividend on similar type companies? So the annual dividend in this example on CenturyLink was $2.16. The dividend on AT&T was $2. But if you look at the dividend yield in 2018, CenturyLink was 12.2%. while AT&T was only 5.3%. And so if you're out here looking for a dividend, high-yielding dividend stock, you might be very tempted to look at CenturyLink, as it has almost double the return on a dividend as does AT&T. And you look at the projected 2018 earnings, though, CenturyLink only projects $1.23, while AT&T projected $3. This was in 2018. And then the payout ratio was 176% for CenturyLink and 66% for AT&T. Now the dividend trap comes that these look really high and you would be tempted to invest in CenturyLink. The problem is that when you have a company, a dividend paying company that has a very high yield, especially when that yield is in very high compared to its peers in the industry, essentially that yield, that dividend becomes unsafe. It becomes unsustainable for that stock, that company, to pay such a high dividend. And ironically enough, that's exactly what happened this week in 2022 with AT&T, as AT&T was having a very high dividend, even though the stock would continue to come down. Obviously, as the stock price comes down, the yield goes up. But AT&T announced that it is cutting its dividend in half. And so if you invested in AT&T for the sole purpose of that dividend yield is now in half, and the stock price is significantly lower. This is a dividend trap. So how do you spot a dividend trap so you don't fall into this trap, investing in a company for the dividend only to find out that that dividend gets slashed or eliminated completely and the stock price continues to dive at the same time? The most obvious way to spot a dividend trap is by a dividend yield that looks too good to be true. Specifically, a dividend yield that doesn't make sense within a certain industry. If you're out there looking for high-paying dividend stocks and you find one that has a significantly higher yield, 2, 3, 4 times higher than the rest of the stocks, you're not a genius for finding that. There's a reason that that yield is very high. Let's go through a little bit of an example here. For example, real estate investment trusts, or REITs, typically pay dividend in the 4 to 7% range. So a REIT with a 6.5% dividend wouldn't necessarily be a red flag. It's well within that industry average. It doesn't seem too good to be true. It's in line with other REITs. On the other hand, bank stocks seem to pay an average dividend yield of 1.4%. And as of this writing, so a bank stock with a 6.5% yield, well, that might be a sign of a dividend trap, as it's almost 5 times higher than the average bank stock. Now let's be clear, this isn't a foolproof way of spotting dividend traps. However, it's certainly an indication that you should take a closer look into the fundamentals of a stock before investing. Now, here are a couple things that generally mean you should stay away. If that company has lots of debt. Stocks that carry too much debt are more prone to cutting their dividends during tough times because they have to use that money, they have to use that cash flow to pay or service that debt. A good metric to look at is the stock's debt to equity ratio. And generally speaking, an ideal debt to equity ratio will be below 1, but slightly higher is often okay. So the debt to equity ratios tend to vary considerably between different industries. That's why when you're comparing these stocks, it's important that you're comparing them to other stocks within the same industry. Do not compare the dividend yield on a REIT with that of a bank. That just doesn't make any sense. So if you're comparing dividend yields, compare one bank company to another bank company or one REIT to another REIT. Another warning is dividends exceed earnings. A payout ratio is a stock's dividend expressed as a percentage of its earnings. So here's an example. If a stock earns $5 per share and pays a $2 dividend, its payout ratio is 40%. Now, I like to see payout ratios somewhere in 50% or less, with the exception of REITs, which are required to pay out most of their earnings. So in any case, a payout ratio in excess of 100% means that a company is paying out more than it earns. And just like your personal bank account, just like your personal finances, if you're spending more money than you're bringing in, it's generally unsustainable. So here are some things to keep in mind if you're concerned about the dividend trap. First off, you should never buy a stock for the dividend alone. You should be looking at your decision on the buy a stock based on that stock's price. If you're a value investor, you believe in this company long term. If you're looking at and investing in a company slowly based on that dividend yield, there's a good potential that you might fall into a dividend trap. A high yielding dividend stock is high for a reason. Your buy and sell decisions should be based on factors unrelated to the dividend, the story of the company, PE ratio, value versus growth, overall trend in the market, overall trend in the economy. If you want to invest in dividends and don't want to fall into the dividend trap, but you still want to harvest these dividends without holding the stock and without taking that risk, there is a way to do that. It's called dividend scalping, and I'm going to share a video with that shortly. And what that is it's a way that you can collect the dividend of companies without holding them for the long term. And here are my top 2 dividend stocks as of February 2022. Number 1 is Mondelez, MDLZ. See the upward trend on this chart. The current yield on Mondelez is just over 2%. It is a snack company and should do well in a recession if that's where we're going with higher interest rates. My second favorite dividend stock is Pepsico. Look at this chart. Also, bottom left to upper right keeps going up and still has a current yield of just over 2.5%. Once again, I think this is a company that is becoming in favor as we see the great rotation happening here in 2022 as growth turns into value. This stock looks good, the company looks good, and it pays a dividend. If you enjoyed this content and you're interested in following me on other channels, I'll put a link in the description. Come on over to TikTok, have a lot of fun over there, as well as all my other social media is in the link below. See ya.